잠시만요. 이지 말자 다.
There's something in particular you'd like to see? This is the result of an experimental growth serum I developed. It can easily feed a lot of people. Once the test is complete, the growth serum can be used to align the limbs. Sure, we hate to see it fall in the wrong hands, so we might just use it to try to get rich. What's next?
Okay, Sandy, administer the growth serum.
I don't know your crap. I can't predict what's going to happen. Do you mind holding?
Thanks for the tour, Sandy. See you later. Krusty Krab.
Daddy, he's coming long way.
Here, put it in this grocery bag.
Grocery bag? Let's get a grocery bag.
Grocery store.
So, how much is this about to get?
Hey, who cares? It's an endless supply of free patties. And cook up fast, boy. We got customers. Okay, that's great, SpongeBob, but you don't have
I'd say this, but I gotta get on this tempted. Let's just have a step there.
Whoa, this is a dream come true. You can't just Find the success of his biggest competitor? Me?
Open it on the alley. A giant monster.
It's the largest Krabby Patty the world has ever seen. It's
Oh, where's SpongeBob? I just had the strangest dream. I was being chased down the street by a giant Krabby Patty. What are the fishes home, SpongeBob?
She has to be. This is her treat zone. Celebrate, where are you? SpongeBob? No, SpongeBob. Up here. Oh, whatever your treat zone. Well, that giant soybean got too big, so I chopped it up and turned it into a giant salad. And then we gotta eat giant croutons. What's the matter, Patrick? Air sickness?
Oh, oh, salad.
And now that I've mastered the soybean, I can master that patty. Really how? The Puzzle Cube told me. The key to defeating the patty is you, SpongeBob. All I have to do is get close enough to it so you can make direct contact. Well, then, sure. The Puzzle Cube never lies. Okay, we have a visual. Putting you into position, SpongeBob. Well, giant patty. I guess it's just you and me. Wait, just make direct contact. It's working. Keep going, SpongeBob. You can do it. This much Krabby Patty isn't impossible. There are just many Krabby Patties in my body. Well, like that. Copy that.
That's it. Go crowd. What's the price list? Don't be shy. Come on. Hush, fine. Why don't you watch where you're going? Yeah, shoot.
Hey, little Bubble, where'd you come from? Perhaps it's wonderful to shed some light on your origin. It's my old friend Bubble Buddy. Wonder what's up with him? Let's see now. Dear SpongeBob.
The missus and I have to go away for a few days, and our regular bubble sitter is sick. Could you please watch our sun shining until we get back? I know you one, your pal Bubble Buddy.
Please keep shining away from sharp objects. We don't want it to go pop like kids like Uncle Raymond. Oh boy, did you hear that, Gary? They want me to watch Little Shiny. Gee, I wonder when he's going to show up. The letter doesn't say. I can't wait to meet him. There you are, Shiny. And you are just a few seconds. Upsy daisy. Say hello to Shiny, Gary. Oh, you're full of selfish vinegar, aren't you? I can't wait for all my friends to meet you. This is gonna be great, Shiny Bubble. Down the daffodil. Squidward loves you, memories.
No, I don't.
You can hug Squidward. Be lots of fun. So, how was your trip? You don't talk much, do you? Guess he's not home. Oh well, we can try again later. What? Shiny, where are you going? You can't go in there. You want to find it.
Would you please get your friend out of my house? There you go.
Squidward, this room is so full of sharp, jagged, broken things. This is no place for a delicate little bubble boy. There is. Don't worry, I'll send him. No. Daddy class. Barbed wire. Cactuses. Cactuses protected by barbed wire. Shiny must be in this one. Gotcha. So, guess not. You don't think he could look Bob in there?
There he is. He's here to fight for my class menagerie.
Oh, still Shiny. I'll get you down. Okay, Shiny, fun is fun, but it's gotta come down now. Barnacles. Oh no! Shiny, come back! There he is. Take it from the open window. I got you, you little rascal. It looks like Shiny wants to be an artist, just like you.
SpongeBob, I spent 6 long months on that painting.
Don't worry, Squidward. Shiny's made himself. Put the brush it on. Here you go, please, Neil. Really captures your inner self. Oh my, look at that. Time to go right. See you later. Bye. Hi, Mr. Krabs.
Finish. Wasn't the grass buffer?
He's not glass, Mr. Krabs. Remember Bubble Buddy? Well, I'm taking care of his son.
Bubble, the guy still owes me money. So, what did it get me today?
Allow me to introduce Shiny Bubble. Shake hands with Mr. Krabs, Shiny.
Right there, lad.
Hey! Ooh, you might want to be careful.
Give me the rest of it.
Don't worry, I got it. Wow, Mr. Krabs, look how shiny and you.
Look at that. Look at that. Never been these clean on a weekday. Why don't you take Shiny there in the kitchen and let him play around with the dirty dishes?
Wow, I think Mr. Krabs really loves you. Now you follow me while I tend to the grill. You sure are lucky, Shiny. You get to learn all about the glories of the
Hey, Shiner, you show me a sizzling grill, and I will show you a happy customer.
What in the name of Neptune is going on?
There you are, Shiner. I've been looking all over for you. Thank goodness you are here.
You better get him out of here if you want to keep him that way. What was today? They don't seem to understand the value of money.
That's okay, Shiny. It's too dangerous for you to work at the Krusty Krab anyway. But there are a lot of unsafe things we can do, like staying in place, or sit in place, or let's not move at all game. Patrick is really good at that. Johnny, where are you? Shiny, no! Not the city! It's too dangerous! Johnny, where are you? No! Johnny, no! Yeah, safe and sound. Now, Shiny, now, Shiny, let's go. That was a close one. Okay, Shiny, let's get you back to my house and keep you away from sharp, pointy things. Shiny, no! I said no! You need to watch where you're going. You can get popped in a place like that. Hold on, there's some tickle in my nose.
Okay. Good evening. So sorry about starting the lecture behind the schedule. Let's start the question now. Let's start the lecture. Sorry, please, just a minute, please. So today lecture we shall continue from where we stopped. So we have been able to talk about the presentation of the financial statement. We have been able to deal with the adjusted transaction in financial statement, which means the time we talk about the depreciation, we talk about the bad debt. At the same time, also we talk about the accrual and prepayment. So we're able to look at inventory IAS2 as well in the last class, when we talk about the IAS2, that inventory is such a part of what current assets, and they use two methods to prepare two systems, which are the number one, the perpetual, number two, the periodic system. And we also look at the cost formula. We talk about the FIFO, the LIFO, and the weighted average. I said that the standard actually was mentioned two, which are the FIFO and weighted average. Then from there also we're able to look at how to the initial measurement of inventory and also the subsequent measurement for inventory. So we're able to look at it that we have two types. Okay, so we're able to look at the accounting treatment as well under these two type of system. So we're able to look at the difference there, and I believe that the knowledge have actually been passed. And I said, anytime you have questions, you can really work back on me. So today we move forward to our lecture. I'll be talking about preparation of financial statement with IAS 1. Today we shall be talking about IAS 1. From there we move to preparation of share statement. IAS 1 is what? Presentation of financial statement. The main purpose standard is actually what? To set out the overall requirement for financial statement, including how they should be structured, the minimum requirements of their content, and overriding concepts such as going concern the basis of accounting and the current and non-current destination. So that's the major purpose why we are having this. So the reason why, for even from the name, a presentation of financial statement, I believe this is actually what should have given us an insight for what we are about to learn in this topic. So what we are trying to look at, the basic things, the standard, the principles. What are the things that we expected to look at? What are the things that whenever we pick a financial statement, that we are going to see the basic requirements that will be common among the industry or among the country. So that way I say the standard required a complete set of financial statements. So if the standard say that a financial statement must be complete, and how is it complete? It complete because it must have what we call comprises of statement of financial position, it comprises of statement of profit or loss and under comprehensive income, a statement of changes in equity, and statement of cash flow. Then we have note of the account and other reports as well. But these are things that must be what will be in your financial statement before we can regard it as a complete financial set of financial statement. And this standard is not saying that okay, these are the things that we expect to. And the IAS 1 was reissued in September 2007 and applied to annual base or annual period beginning on or before 1st January 2009. So this was reviewed and was issued because they are just things there and so issued as September 2007. So you need to know this. Like I said in the beginning of the class, like we have from 5th standard, you just have like 5 standards. And we have looked at number 1, we have looked at IAS, part of IAS 1 before. Number 2, we have looked at IAS 2. Number 3, we have used IAS 16. So we are left with IAS 7 and IAS 8. These are the 2 less standards we are left with that we need to look at in your own at this level. So now the objective of this the objective is actually to prepare the basis of presentation of general purpose financial statement to ensure comparability both with the entity financial statement of previous period and with the financial statement of the other entities. So what this page is talking about is that the major reason why we have the objective of IS is actually to prepare what we call general purpose financial statement. General purpose financial statement, if you remember in the beginning of the class, we mentioned that users of financial statement can be classified into 2, which are the internal users and external users. Because we have external users, and external users cannot request for the accountant to prepare the financial statement in a particular way that will be useful for them. That's why what the standard now comes in that, okay, what are the basic things that the external user might need for them to make their decision or to act upon the financial statement. So the word they prepare, according to the standard, what we call general purpose financial statement, which means it can be used by it can be used by the internal user, at the same time it can be used by the external users, and we mentioned examples of that. Okay, now that's so another reason why the objective, what they intend to achieve on IAS 1 is also to achieve what we call comparability. Comparability in the sense that we have a business that is working here under trading, or let's say for example, we have a manufacturing company, polythene manufacturing company in Nigeria. We have another polythene manufacturing country in another country. Then what they should be able to compare the financial statement together. Because if you have the basis, we have the format, we have the requirement, we have the concept, we have the rules that they agreed on, they use the same rules to prepare the financial statement, then it can be compared together to know the strength of the each company. So it can be a benchmark So another company can be a benchmark to you to know if you are actually improving or you are what, or you are not doing well. So another one also comparability in the sense that the year as well. The standard actually was required that okay, comparability, okay, last year and this year. That's why if you look at the cash flow statement, it will also require you to put 2 years there so that you can compare. As last year, I make 1 million. This year, I make 1.5. It means that at a glance, you can tell that what that you have increased over time. So it means this is one of the objectives. Number one is to prepare general purpose. Number two, for comparability previous month or people entity, the same entity in what in the same entity in the same industry or same industry, or just to check if there's a growth or not. So I set out all the requirements for presentation of financial statement guidelines for their structure and minimum requirements for their content. So this standards talk about number one, I talk about the what you expect to see in financial statement. You talk about the component of financial statement. You talk about the elements of financial statement. You talk about the tax. You talk about the dividend. It talks about the template. Talk about the how we display expenditure on our financial statement. So these are the things that it addresses. So now let's look at the scope. The IS1 applies to all general financial statements that are prepared and presented in accordance with international reporting standard, which is what IFRS, that International Financial Reporting Standard, that International Financial Reporting Standard. So that's the major reason why any financial statement that is not prepared in line with this standard will not be, this standard might not be applicable to them. So the general purpose financial statement are those intended to serve users, like I explained, that are able to serve users who are not in position to require financial position tailored to their particular information need. They are not required for, so they are not required that. So let's look at the objective of financial statement. I'll just summarize this because we have done this before earlier in first class. So objective of financial statement. The objective of financial statement is to provide information about the financial position, is to provide information about the performance, is to provide information about our cash flows within the entity, to know the range of economic added and the one that will be taken out. That's the objective of the financial statement. So it means that okay, I want to know what is my business, how my business perform over time. Is that my business have performed okay? It has been increased by 20% or it has reduced by 10%. Also, what current state am I in right now? The business. Am I actually in financial crisis or am I actually buoyant enough to go on? So it has to the financial position that okay, this is what we have, this is the asset that we have, this is the liability that we have. It helps us to state our financial performance. This is the value that we have added to the business. That's the profits, the value that be added to the business, or the value that is taken away from the business, and also our cash flows, inflows or outflows. If we have more outflow than the inflow, it will tell us that something is wrong. Whenever you see that okay, my outflow is more than inflow, then what are the things that constitute my outflow? These are the things also that the financial statement actually prepared. So to meet that objective, the financial statement provide information about the entity. So for you to know information about the entity financial aspect is it provide information that regards to that entity. So if I pick any financial statement, if I pick let's say FCA, or I pick any bank for financial statement, that financial statement is telling me the financial transaction of the FCA or of the particular bank that I'm reviewing. So for that, we have what we call the asset, the liability, the equity. We have the income and expenses, including gain and gain. We have the contribution by and distribution to owners. That's equity or contribution by and distribution to owners. Then we have that, which is in form of cash flow. Now, if you look at this, these are the elements of cash flow. Like if you remember, I explained in the beginning that we did the definition of this, and we said that whenever any transaction does not fall within this definition, then it should not be regarded as as a financial statement that will be entered in our the financial transaction that will not be entered in a financial statement. So with the last one that is new, there is contribution by and distribution to owners. Contribution by means that introduction of capital. when the owners of the business introduce capital to the business, it means that what their equity or what it will increase, what contribution as, and that will serve as well as a reduction. Also, it talks about also when you talk about the distribution, paying out to the maybe it can be in form of drawings or it can be in form of what dividends. When you pay out to what to your owners, when the owners is taken out of the what out of the business for their own personal what consumption, probably what due to their investment or due to their needs. That's what we call what contribution by and distribution to owners. So that's what the objective of financial statement, to help us, to guide us for control purpose. Number one, for decision making. Number two, for performance evaluation, for stewardship, needs, for accountability and transparency. These are the objective of financial statement. These are the what the financial statement help us to achieve. That is what financial statement help us to achieve. So let's look at components of financial statement. What are the components of financial statement? When you talk about component, when I talk about what components financial statement, when you hear the word financial statement, what do you think you are looking towards? What do you think? What's your expectation? What are the statements? What are the documents? What are what constitutes the financial statement? So the first one that we have is what the statement of financial position at the year end of the reporting period. I remember I said that when it comes about reporting period, you can also see financial period. You can also know what financial period, reporting period. That's a financial year. These are the other names for reporting period. And reporting period is all about 12 months. This standard says that what financial statement must be prepared within 12 months. That which means they believe that with 12 months is a year, that shows that what financial statement should be prepared on annually basis. So the statement of financial position at the end, not at the end. So please note that the statement of financial position at the end of the reporting period. So that's why when you look at some solution, you see a statement of financial position as at 31st, as at the year end 31st, so. So it will give us what? It will give us the time that at this moment, so this is our statement of financial position. And when I talk about statement of financial position, it's just a statement that shows that classify or give us information about our asset, the liability, and the equity. That's the statement. That's what the statement. So the statement consists of the assets, the liability, and the equity. Then after that, another statement that we are going to see in the component of what financial statement is a statement of profit or loss and other comprehensive income. That's what we call statement of profit or loss with a separate statement of other comprehensive income. This is the one that shows us the performance of the organization for a particular period. It tells us that okay, fine, this business have actually they are into trading, and over trading they have purchased this item, they have sold this item. These are the costs related to the revenue, and this is the profit that have been derived from the activities, from the principal activities of the organization. Then it now shows that the other comprehensive income are the transaction not directly related to the principal activities of the organization. For example, when you have what we call when you have a revaluation surplus. Revaluation surplus is an example of what? An item under other comprehensive income. When under comprehensive income, and this is your standard, you are not expected to actually to be full detailed in it. I'm just saying this for us to know it, but you are not expected to have full details about it. So another statement that we have is statement of changes in equity for the period, or statement of changes in net asset. Now they are talking about okay, your equity at the beginning of the year is what amount, then your equity at the end of the year is this amount. So what led to the changes? So is the table that will disclose that will show us that okay, this is statement equity. We have capital. Capital at the beginning of the year was 20,000, but the owner introduced another 5,000. Make me at the end of the year will not be 25,000. That's addiction. Then we have another one as well. Another example of equity is what retain profit. Retain profit also is another example. How is the retain profit another example? Because whenever the link between your statement of performance and statement of financial position is your profit is the linkage. So it shows that okay, at the beginning of the year, I have so profit. At the end of the increase, after my profit increase, I'll show you that if there's a dividend payout from here, or if there's any adjustment on my earnings or my retain earnings, I will show it. I will display it on the statement of changes in equity, which means tell us how equity have changed over time. Then we have statement of what cash flow. We are talking about statement of cash flow for the period accounting policy note and under what explanatory note. So this one is talking about what are you talking about? Statement of cash flow. Statement of cash flow is what ISM that address that, and we are going to talk about it in details. So ISM is all about what statement of cash flow. That how do we prepare it? What comprises it? Our inflow. Where do we get our money from? Did we spend our money on? So what do we spend our money on? So okay, give and take, it helps us to know the inflow and the outflow for us to plan, so that we will know. We will try as much as possible to avoid or to be bankruptcy. Then we have what called the other accounting policy as well. We have a lot of policy. Standard is the word is the principle base. IFRS is the principle base. It allows us to pick the policy that is suitable for the organization. So when you select the policy that is suitable for your organization, you are expected to document it down, and the management is expected to approve it. That this is the policy that will be approved and will be implemented in our organization going forward. Examples can be what when we talk about IAS 16. We talk about IAS 16 that talk about either we do what cost or evaluation method. So if we use the cost model is allowed what if the organization, the management says that we are going to use cost model to value or to record our assets, then that's the accounting policy that I've decided to go with regarding to the assets. And that also they can also talk about the depreciation percentage. Decision percentage that okay, this is our cost of our business. We have looked into, we have reviewed into it, and we believe that these are the decision percentage that is okay. These are the example of the element of accounting policy. We have borrowing costs as well. How do we account for what we call inventory system as well? These are the things accounting policy that have been brought together to now guide the preparation of the financial statement on a normal basis. No financial statement is expected to be prepared without approved accounting policy by the management, because it's this accounting policy that will guide us to know that this is how you have prepared your financial statement. Then we now have another word which called note to the account. Note to the account also is another component of financial statement. It gives us details. It gives us full details about I give us further details about the figure that can be found under the statement of financial position and also under the statement of profit or loss account. It also helps us to disclose some requirements that are being enforced by the standard. So when the standard asks us disclosure, we normally disclose it. When you have further disclosure, we put it under note to the account, which means if you need more information about the particular transaction, please go to the note to the account. Then we now have a statement of financial position at the beginning of the earliest comparative period, which means okay, now if we have this year, we need to compare it together. Okay, this is what we have done. This is what we have done over time. If there's any changes in accounting policy, or there's changes in accounting estimates, or when there's need for correction, then at a glance you'll be able to know that okay, this is what was presented and it will be corrected. That's why we're having a different figure here. I see that a statement of financial position at the beginning of the earliest comparative period when an entity applies accounting policy retrospective, which means going backward. We talk about it in IAS 8. We talk about changes in accounting policies, accounting estimates, and errors, correction of errors. So we're talking about that, so that whenever there's a change in accounting estimate, whenever we retrospectively by going backward. Whenever you go backward to correct the information, which means like 2018 financial statement, you're not going backward to correct it. Then you have to show the previous one and the new one, which means comparative figure. So let's move forward. So other reports also, we have other reports, like I said, we have management report, we have environmental report, we have what do you call, we have a lot of reports, social reports. There are airports to what to get. We have auditors reports. We have the directors report. These are the things also part of what component of financial statement. But the standard say others report, which means is what you can add it, you might not add it. But the one that is actually very, very important for you is what is have stated out that you must have it in your what in your financial statement. It is statutory for you to have such statement in your financial statement. Now, so let's move forward. So exceptional items, I've explained this earlier. It means that there are some figures that due to their sizes, due to their nature, due to the nature that is disclosed, you are expected to give them information, further information in the note to the account. That's what you call what? The exceptionary item. Is that due to their large. If you have opening, probably your profit is like $1 million, then you now have an expenses that are like for something million naira. It means you are what you expect what to disclose it because of what? Because of value. I'm still saying it's still subject to what? To the management policy. The accounting treatment is to what? Include the item in the substandard. Sorry, include the item in the standard statement of profit or loss account, the line. You include it, which means if I have a figure here, I'll now put the note to the account 20. When I put the note to the account 20, it means that what can go forward and find that amount there, which means we give you a further explanation to that. Disclosure, the nature and the amount in notes. So we have to what? Disclose it, the amount in notes. So now if we move forward here, we have what we call the example. So let's look at the examples of what the exceptional item that we expect to disclose, that we expect to show. Example is what the written down of inventory. Written down of inventory to net realizable value. So whenever we are what written down of inventory, we okay, fine. This inventory now we need to what we'll reduce it due to one or two reasons. Then we need to disclose it. We need to let them know it. It has to appear. It has no line under our statement of profit or loss account. Also, whenever we write down what an asset or recover an asset, a revaluation, then you have what under the OCI, you must disclose it as well. You must state it under your OCI that you have written down your property or you have revalued it upward. Or if you are restructuring as well, is what you expect to also what exceptional item. You know, exceptional items are found under what? Most of them they are found under the statement of statement of profit or loss under the OCI, other comprehensive income. Disposal and what of asset disposal. Okay, so this when you make gain or losses on the disposal of non-current assets as well, you are expected to show it as what as gain or as loss in your financial statement under statement of profit or loss account. So we have discontinued operation. When you stop a particular branch, you have like 10 branches, and you now branch, you make sales of a particular branch, your revenue will increase. So you expect to disclose under your profit will increase. So you sorry for the network. Let me share my screen. Okay. Okay, welcome back. So we have that. So also when discontinued operation as well, when you have an asset, probably you have 5 branches and you let go of one, you sold one, you discard one, then your profit will increase for the year. So you expect to disclose it under the note to the account that one branch is you have actually let go of a particular branch. So you have we have to disclose it, because if you don't disclose it and anybody pick that financial statement, it can be misleading. Misleading in the sense that they might actually think that what you are doing well, you're in that is because you what you dispose a particular branch in an high of for you. So litigation settlement, that's what we call contingency. If you know that okay, based on what your lawyer or your professional person advised you that the way the case is going is probable that you're going to what they are going to be subject to a fine of let's say 200 million, and that's what you expect to, and it's due to the transaction that you have done in that financial year, in that reporting period. You expect to create that provision. It must be in that transaction of that incident that will lead to the litigation amount must be within the reporting year. It must have occur in the reporting year. Not that in 2019 and something happened in 2020, I will not take litigation, I will not put it back. No. That litigation must be as a result of what occurred in 2019, but see in court that will be decided on in 2020. So you can now you can put it there. So you have to disclose it as well. So that the exceptional what because of the value and the nature, because they are very, very sensitive because material. It's material in nature, because the inclusion or the omission or what we call misstatement can actually affect the economical decision user of the which means the financial user desire to go ahead with when you make the statement. If those figures are added or not added, it is material. Then let's move to statement of financial position. Now, an entity shall classify an asset as statement of financial position if you classify it as asset under because the standard IS1 says that assets must be divided into two. You must have what we call the non-current asset, and you have what we call current asset. The same thing goes to the liability. Liability also they are divided into two. We have the non-current liability and we have the current liability. So we're not saying that before you can classify any asset as current asset, it must fulfill this obligation, which means it expect to expect to release the assets. It expect to realize the assets. It expect to realize the assets or intend to sell or consume it in its normal operating cycle. Can you see that word? In its operating cycle, which means that you expect to realize the asset or intend to sell it. You have a plan to sell the asset, or you have a plan that you are still going to collect the asset later or in the future because of what? Because of your normal operating cycle. Example of this what called inventory. Also trade receivables. Inventory in the sense that you have it intent to sell, so that when you sell it, you take another you collect cash. That's an example of a current asset. Trade receivables. It means you realize it's expected to realize the asset. That trade receivable, you are going to collect the money later on in the future. So that's what we call it because, and this falls under normal operating cycle, which means my principal purpose of doing business is falls within it. That's why if you look at some companies they say that their vehicles is non-current assets. While some companies say that vehicles are current assets. For example, if I'm into sales of cars, those cars are inventory, because I intend to sell them, or I intend to consume them, I intend to sell them. So that's an example of current asset, because I'm a car dealer, is my inventory. But if I'm a manufacturing company or I'm in a trading company, that motor vehicle will not be in current asset. It will be not current asset, because I don't have intention of selling it. Now, another thing that we need to consider also, it holds the asset primarily for the purpose of trading. So if they are holding the asset primarily for the purpose of trading as well, we can classify our current asset. It expects to realize the asset within 12 months after the reporting date. Now, current asset means that what? That you can easily what? You can realize what? The economic benefit within what? Within 12 months. Within 12 months. If it's more than 12 months, it cannot be classified as what? As current asset. Now, this 12 months I'm saying is that when I'm reporting my reporting year as at 31st December 2019, I now put a particular thing as current asset. It means that in year 2020, I'm going to realize all my current assets. If it's not possible for me to realize those items in 2020, that is in 2021, then I will not classify them as current asset, because current asset is an asset that is realizable within 12 months after the reporting period. Then we have cash and cash equivalent. Cash and cash equivalent, or what? I think cash liquid, or any item that it can be easily convertible to cash within a short period of what? Time. Very, very short period. That's what we call cash and cash equivalent. Cash and cash equivalent. Example, we have cash at hand, we have a short of time. You can go to the bank and obtain cash. So we have cash and cash equivalent. Now, any other asset that does not fall within the four features that we have mentioned, we will have to classify as what? As non-current asset. If the asset is not expected to be realized within 12 months, if the asset is not for the purpose of trading, if the asset is not to be able to be consumed or used or consumed within that period, or for the purpose of operating cycle, and if it's not cash or cash equivalent, it will be regarded to as what? As non-current asset. As non-current asset. Now, an entity also, we are talking about statement of financial position. An entity also shall classify a liability as current on the statement of financial position if that's a condition as well. If it is expect to settle the liability in its normal operating period, operating cycle, which is it is expected to settle the liability in its normal operating cycle. Another one, it owes the liability primarily for the purpose of of trading. Then we have the liability is due to be settled within 12 months after the reporting period. That which means whenever it's now more direct, like the example I gave when I was explaining current asset, that if I'm reporting my financial statement at 31st December 2019, then I know that amount that I'm owing, I will pay the amount in 2020. Then I can classify it as current liability, because it's within my payment. The payment is within the next 12 months after my reporting period. It does not have any unconditional right to the fast settlement of liability for at least 12 months after the reporting period. So we can't defy it. You can't say, oh, I'm not paying 2020 again. I want to pay 20. No, you can't defy it. It must be settled within the 2020. It has to be settled within. You can't defy it. It's unconditional right. It does not have unconditional right to defer settlement of the liability for at least 12 months after the reporting period. If any other liability does not within the fourth feature, it will be regarded as as long time liability. Also, the name is long-term liability. So if you say it will be the same thing as with non-current liability. So now, let me just explain this so that you can see. So when a long-term debt, if you have a long-term debt, that span for a space of, let's say, 5 years. Now, 5 years, and you know that you're going to pay the money. So let's say 5 years, yeah, 2019, you collected the money in 2019. You're expected the payment to start in 2020, and you're expected to pay it for 5 years. So in year 2020, you are going to recognize, in 1919, that reporting period, you are going to recognize 1 year as current assets. Then the remaining 4 years will be added to as non-current assets. If I borrow 20,000 naira in 2019 and expect to pay for 5 years, now 20,000 naira divided by 5, we give me 4,000 naira. Yeah, is it 4,000 naira by 5? Yeah, 4,000 naira. So that's what I'm going to pay for 4,000 naira for 5 years to get 20,000. Now in 2019, if I'm reporting it, I will now have my current liability will now be 4,000 naira. You know, the total is 20. I will now say 20,000 minus 4,000, which is the remainder that I'm going to settle for 4 years. But that will give me 16,000. So my non-current liability is 1,000, which means now non-current liability is not subject to settlement for the next 12 months. For the next 12 months. But after 12 months, it will be subject to settlement. So now the one that is subject to settlement right now is what is the one for 2020, which is what 4,000. For 2021, 2022, 23, 24, will now be found under the non-current asset. Now, if you not add the non-current liability plus the non-current liability for the current liability to give you 20,000. So we have non-current liability to be 16,000. We have current liability to be 4,000. 16,000 plus 4,000 will give us 20,000, which is the total liability that we own for the maybe bank or what our creditors. Okay. Now, so I'm saying any IS1, please. Okay, move to because of time. Let's move to our statement of profit or loss and other comprehensive income. Now, other comprehensive income comprises of income and expenses that are not recognized in profit or loss as required or permitted by other IFRS. So it means other IFRS say that okay, don't put it there, put it under this area, put it under this. Okay, so it will be what? It will be found under what? Under the profit or other comprehensive income. It's an income, but it's be under other comprehensive income (OCI). Like I say, you don't need to bother about this. You don't need to bother too much about this now. According to your requirement in your examination, your is not needed. So what you need to focus on now is what is the total comprehensive income, which talk about what the statement of profit or loss. Now this is a charge, is a change in an equity in the entity equity during a period resulting from transaction other than those with the owners in their capacity as owners. So this is what is defined by IAS 1 as the change in an entity equity during a period resulting from transaction other than those with the owners in their capacity as owners, such as issue of what share capital or payment of dividends. In simpler terms, total comprehensive income is the total of the equity profit or loss and other comprehensive income for the period. So the addition of the statement of profit and loss account plus the other comprehensive income will give us total comprehensive income. Now this total is what is a change in equity because we are going to take that amount to our statement of financial position under equity. You know, when I explained earlier, I said statement of equity, statement of changes in equity is that at the beginning of the year, I have this earnings. Then during the year, I make these earnings. So at the end of the year, my earnings are whether increased or what or reduced. So with the link between the statement of financial position and statement of financial performance is what is the profit. Okay. Now I've explained the statement of changes in equity. So we have a statement of change in equity. The statement of changes in equity provide a summary of all changes in equity arising from where? Arising from the transaction with owners in their capacity as owners. This indicates the effect of shares issues and dividends. So then we look about we are still going to look at the accounting concept and talk about issue of shares. How do we which account to debit to credit. So now general features of financial statement. What are the general features of financial statement? Concept, going concern. Going concern, it means that once management have actually ascertained that there is no material uncertainty, that the ability for them to continue for foreseeable future is guaranteed. There it means the financial statement must be prepared on the going concern. Once the management have ascertained that or assess that there is no material uncertainty that will affect their going concern, that will affect them to continue operating in foreseeable future, then the financial statement must be prepared using concern concept. But if it's what it is probable that the business might not be in future, but we might not be in existence in what in foreseeable future. Then the going concern what, especially the day they liquidate that business, the going concern concept will not be applicable to that organization, will not be applicable to that organization. And that one is the accrual basis, like I explained. Accrual basis means the what the accounting process method that is used to document transaction or event or financial event as what as at when they occur. The what these are acquired based what accounting means that transaction and events are what transactions are documented when they occur, not when money is received or money is paid. It's when it is occur. Then I will then in the beginning of the class, like I said, that we have what we call three bases or preparing financial statement, which is what the acquire basis, the cash basis, and breakup basis. Now, if the going concern is not applicable, they use breakup basis. If acquire basis, they use what, which means it's not until I receive money or I receive my revenue that I will record it. It's when I know I have earned my revenue, I record it. Then you mean what you are using accrual basis. Then cash means that what cash transaction, that whenever there is any financial transaction, financial event or transaction that involve movement of cash should be recorded. But if it does not involve movement of cash, it should not be recorded. So, but majorly, the organization use what called accrual basis, except is what stated by what by the organization, the management, or by the standard. Then we have the consistency of presentation. You have to be consistent. It means that what the policy that you have used this year must be the same policy you use now. You're going to use next year. You should not be changing it up and down because what? Because there's comparability. Now, if after an 18 year and after an 19 year, and they use different policy or they use different method, probably this 19 is accrual basis, 18 is cash basis. It will be misleading to the person that is what that will use it because there are some transactions that will not be added under cash basis. But under the accrual basis, you find it there. So the figures will be misleading. Those figures will be misleading. So you have to be consistent. What the policies that you have taken, the policies and what you have accepted, what you have stated are that this is why you are going to prepare your financial statement must be key into. They must what? You must key into it and you must not be changing it on a frequent basis. Now, it is clear that a change will result in more appropriate presentation. So it's possible that there will be a change once in a while. Yeah, fine. It's okay. But should not be what on a frequent basis. Should not be on a frequent basis. Another one also is the materiality and what and aggregation. And materiality, an item is material. If like I explained materiality concepts, an item is material if its omission or misstatement could influence the economic decision of user taken on the basis of the financial statement. It means that if we add this figure, probably for you expect to be 200,000 and you put 20,000, I might take another decision. If I actually see 200,000 naira, if you think that it's material, the addition, adding all together, okay, looking at it, you have actually done an error or you have actually omitted a particular figure that is, let's say, 1 million, and your profit is, let's say, 200,000, and you have omitted the expense of 1 million. That's expense is what is material. It means that what if that expense is brought into play, it's going to affect your profits and you change your profit to loss. Then it means that amount or that figure material is expected to be able to be added back to what it's expected to be able to be adjusted. So and that's where auditor comes in. Auditors try as much as possible to make sure that that everything that is material have been accounted for with the appropriate way and standard. Then we have what you call offsetting. Offsetting is saying that asset and liability should not be used to offset each other. Income and expense should not be what you use to offset each other. Assets and like income and expenses. Income and expenses is that your own mean 10 naira. Or income and expenses. Okay, let's say income and expenses. Now I'm explaining that one was asset and liability. So let's explain income and expenses first. Now income and expenses means I've incurred profits. My sales is 200,000, and the cost of my sales is 5,000. I will now net it for 200,000. No, the cost of my sales is 50,000. So 200,000 minus 50,000, that'll be 150. I will not disclose. I'll just show my financial statement 150. But I won't show the revenue. I won't show my cost of sales. No, that's offsetting. It means that you have offset your expenses on your revenue. So and it's been misleading for people that will use a financial statement. You will not be there to explain things in details all the time. So it's advisable the word offsetting is not allowed. show your revenue 20,000, show your cost of sales 3,000, and on your what, on your financial statement, calculate it out and write 150. Don't offset. Another example also is asset and liability. Except it's actually what, except the standard permits it. If the standard does not permit it, offsetting is not allowed. Another one, asset and liability. So you have a customer that is owing you. You're a customer that serve as what? You have a person that serve as a customer as a vendor. So as a vendor, you're owing him 20,000. As a customer, he's owing you. You're owing him 20,000. As a customer, he's owing you 10,000. Now, so let's offset. Okay, 20,000 minus 10,000, 10,000. You now put 10,000 there in your financial position. It is not allowed. It's not allowed. You have to state it there so that everybody will know what is going on, except what? Except the standard permit. There are few cases that the standard permit offsetting when it comes to what? Asset and liability. So let's move on. We have what? Comparative information. Comparative information means that what? Comparative information for the previous period should be disclosed, both on the faces of financial statement and in the notes, unless a standard or interpretation permits or require otherwise, which means 2 financial years should be prepared. The previous year and current year. The first for the previous year. So we have the current year 2019, we have the previous 2018. Even your note to the account or swear must be prepared in that line, so that anytime they can also take, okay, this is what I made last year, this is what I have incurred this year, this is what I have incurred last year. So they can check it. That's what IS1 is talking about. That what comparative information must be available. And you must be compliant with the IFRS. Compliance with IFRS is also very, very important. You have to be compliant with the IFRS. If you are not compliant with the IFRS, then you cannot use IS1. Because IS1 there must be a disclosure that you are compliant with IFRS. And when I talk about compliance with IFRS, it means that totally compliance in IFRS. And if by any case, during your preparation statement, you actually you didn't follow a particular standard, you expect to disclose it in your to the account. Now, reporting period. Reporting period is an assumption that a financial statement will be prepared annually. It's an assumption that financial statement will be prepared annually. If the annual reporting period changes and financial statement has prepared for a different purpose, period, the entity must disclose the reason for the change and state the amount and states that amounts are not entirely comparable. Changes. Before this year, 2018, I'm operating from January to December 2019, and then I shifted, I addressed it, okay, because of maybe tax purpose or the rest. Then I'm preparing it from June 12 months. The mondial thing is the month of 12 months. So if I'm preparing June to May, it means that I can compare those 2 figures together. So that close that those figures are not comparable. Then we have dividends. Dividends in the it says that there must be disclosure. We have to disclose the total amount of money that you have proposed or you have declared before the financial statement we are authorized. It means that you have to show it. How much have you proposed to be disposed as dividends? And how much have you proposed to be good as a dividends? At the same time as well, how much have you declared? You have to declare it. You have to show it. Even before they approve the financial statement, it must be it must be there. The amount of any cumulative preference shares not recognized also must be disclosed. It must be disclosed. So now let's look at this format of financial statement. So we are using T format for this and vertical format. We are using T format for this class. So if there is a need for us to use vertical format, I will let you know. For at the moment, it will not penalize you for using T format. But when you move to the next level, which is skills, you can use T format. You are expected to use vertical format. That's what the columnar format. So statement of financial performance. Let's start with statement of financial performance. So we have the left hand side and the right hand side. So if you look at the right hand side, which is the credit side, you have what we call, let's start with that. We have revenue. We have return inward. Revenue means that your sales. We make sales. It's also similar to revenue. When you make sales of 20,000 naira, it comes this time. I remember I said that one of the seeing the major tools or the major statement that is used to prepare a financial statement is trial balance. So all the ledger field balances must have been recorded inside the trial balance before you can now prepare it. So when you see revenue, you are seeing the totality, which is the balance of revenue ledger, is what we are bringing down here. Is the revenue ledger that what we are bringing down here. They will now have return inward. If you make sales, they now return it back to you. What do? You have to what? Reduce it. That I say less return inward to have your what? Your net revenue. You have your net revenue. You remember also when we did the inventory, IS2, I talked about this as well, return inward and return outward. That whenever you make sales before and you receive it under the perpetual and also under the periodic. Okay. So after you have that, the other thing you have to what? You have to know, okay, after you have known my revenue, based on my matching concept, it says my what? I need to know the cost of what? Of the revenue I've made, the cost I incur to achieve this revenue. So I need to what? I need to ascertain that. So how do I ascertain that? I need to know my cost of sales. I need to know my cost of sales. And I said, and I what? Our cost of sales is what? Is opening stock plus purchases. You what? Add other value to it. We have the what? The carriage inward. The carriage inward, this is what? This is the cost that we incur to bring the product, the inventory, or the material that we purchase from the point of purchase down to our warehouse. That's carriage inward. That's carriage inward. And wages. These wages is what? Is if it's relative. If it's a direct expenses, it come under this place, wages. But that's for majorly for manufacturing companies. So manufacturing companies, their wages is found under the cost of sales, because if they don't incur it, if they don't incur that wages, then we are not going to produce. So it's directly related to what? To their revenue. Also, if you look from some cost of sales varies from one industry to another industry. Cost of sales for let's say for school, for institution like FCA now, one of their cost of sales, their lecture fee is part of their cost of sales. Lecture fee is what is part of cost of sales, it will be added to our cost of sales. But underly, if you look at other part, they say salary. That salary should not be what? Should not be part of cost. No, but no, the lectures are there because of what they are running the service. So it's directly related to what? To your revenue. So that we have the opening stock, we have the purchases, we add the carriage inward, we had the wages. After that, we less return outward. Return outward is what? The inventory that we have bought before, but we are later returning back to vendors because of faulty or because of discount or many reasons. That is what by the management they are returning it back. So we have to reduce it. So when we reduce it, it's going to give us what we call the cost of goods available for sales. Okay, so that one, if you look at that will give us our net sales. That would cost for net sales, and after that, opening stock plus net sales, cost of net sales. They give us a cost of goods available for sales. They give us a cost of goods available for sales. Then after that, we have what we let our closing stock from it. Once we let our closing stock from it, we will cut off our cost of goods sold. The cost of goods sold is also cost of sales. Then we now what? We remove the balancing figure. That is the difference between our net revenue and our cost of gig sales will give us our gross profit. Gross profit is the profit that we have incurred before other administrative expenses are being deducted from. That's our gross profit before other administrative expenses are being deducted from. So now let's move on. So what are the expenses that will be removed from what? From our gross profit. These are the expenses that will be removed from our gross profit. Depreciation. We did that on what? I think 2 or 3 classes ago, IS16, when we talk about depreciation. So we have land and building, we have plant and machinery. So all these figures that we have been saying that you are going to write it off to this figure, write it off to this, or write it off to profit or loss account. No, excuse me. So these are what you are talking about here. So they are talking about depreciation. Then we have another one that we have is what we call the discount allowed. Discount allowed also means that what? This is the discount that we have allowed your customer to enjoy. So it's an expense to you. It's an expense to you because you have allowed them to enjoy it. You're no longer going to collect the money. Then we have admin expenses. as well. Admin expenses, what are the expenses that the admin have incurred for them to what? For them to carry out the activities that have led to the generation of the revenue. Then we have the selling what? The selling, we have the selling and administrative expenses. The selling and administrative expenses, we're talking about what? The probably the commission or the expenses that we have incurred to sell or let go of the product. Then we have the debenture interest, we have the accrued, we talk about the accrued and the payment, you remember? So we have the accrued, we have what we call the rent, the rate, and the what, and the insurance. Then we now under the other side, we have what we call so this side that we are just done with now, their expenses area. They are actually found under what we call the debit column. They are found under the debit side or the left-hand side. So their expenses area. So now let's look at the other side. The figures that we expect to find on the other side. Please, you need to know these figures, because if you don't know these figures, it might not be easy for you to post items correctly. You must know what and where to find these figures. And at the same time, also remember that I explained in the beginning of the class that we have an 5 elements, and I said that these elements, they have each their balance. That the assets have debit balance, expenses have debit balance, income or revenue have credit balance, liability have credit balance, and equity have credit balance. Yeah, what I'm saying is revenue is an income. And if you find it's found under the credit side. This one is an expenses find for under the side. So now, if we look at the provision for this, is provision for bad and doubtful debt. Bad and doubtful debt. Now, if there is actually what they have two provision for bad and doubtful debt. If it reduce, it will find under here. But if it increase, it will be found under the expenses. It's because it reduce. That's what we are finding under here. Please don't assume that you always find it under this side. It's because it increases. If it reduces, it will be found here. But if it increases, it will be found on what? On the expensive side. The difference. Then we have what? The discount received. Also, you gave discount. You also enjoy discount. Interest received, rent received, commission received. And what? These are the other income. Other income that you find here. And this one is what we call what? The statement of profit or loss account. So there is no other comprehensive income. It's not part of your syllabus. So it's not part of format that we have given. So let's look at the statement of financial as well. So like a statement of financial position comprises of asset, liability, and equity. So we have two sides. Now, equity and liability on one side, asset is on the other side. Now, if you look at the equity here, equity and liability, we are starting what? This equity here, this is the equity section here. Can you see? This is liability section. Liability section is here. It is liability section, and we have this the asset section. So on the right hand side, everything is asset. Everything is asset. So now that we have done that, let's move on. Owner equity. This owner equity, we have what? The opening capital. We have additional what? This, you're not expected to reflect this. You're not expected to show this in your financial statement. It depends on where you can just do your work when you're working to put it for your performance. We have the equity, we have the non-current asset and the current asset, like I explained. With the settlement within the 12 months is what current asset. The settlement between more than 12 months after reporting period is what is non-current liability, and they are both obligations that will lead to settlement. Settlement that what the obligations, credit obligation. So in the asset as well, we have asset, we have what we call the non-current asset. Non-current asset are the one that have depreciation. Like I explained, that the depreciation is thematic allocation of an asset. So it's what we are looking at it over time. Systematic allocation of asset cost over time. That's what we're talking about. Then we have the cost, we have the accumulated depreciation, then we have our net book value. And like I said, another name for net value is carrying amount. Please, if you see carrying amount there, don't be looking for net book value. Net book value and carrying amount are the same. Then we have the current asset. We have the stock, it's also known as inventory. We have the trade receivables. We have the after the trade receivables, you less your provision for bad debt. This one will be displayed. It must be shown on your statement of financial position. So we have less provision for bad debt and doubtful debt. Then after that, we have less provision for the discount allowed. Discount allowed. So we make provision for discount allowed as well. You less it. After that, you had your cash and you had your bank, your current asset. Then you fall. So these are the things that we need to do. Another thing that you need to know is that what under the IAS allows that expenses can be what can be displayed in two formats. Is it about by nature or by function? By nature in sense that what the purpose why the what their nature, their nature. Example of which we have what depreciation, we have what we call the staff cost, we have what we call so they based on their lightning and the rest. Lightning, eat, rent, all these are nature. It will display there. But another way also of recording financial expenses in our statement of financial performance is what is by function. Function in the sense that instead of me mentioning all this rent, depreciation, I'll just say selling and administrative, which means like the department function. Okay, so everything that relates to sales, selling costs or distribution costs, you'll be putting under down. If I say administrative costs, any cost that relate to what administrative costs, any function that relate to administrative costs will be added together to give me that one. So under that one, we have fewer items or the fewer display in our statement of financial performance. But under the nature, we have more of it. So that's why you see also financial statement, when you pick it, you see like just 3 or 4 expenses displayed there. You see the one that is very common, you see the admin, you don't see salary, you see admin expenses. Under that admin expenses, all that expenses are added to it, like salary, rent, and the rest. And that one also you see maybe production. That's production cost you can see there also. Or you see something like what selling and what distribution expense also. If you what it be added there. These are the 2 ways in which we can display your expenses in your what on your financial performance. So now let's look at preparation of financial statement using extended trial balance. Now trial balance, we have extended trial balance, we have trial balance, we have extended trial balance. Okay. Now trial balance is just about the what we bringing the balances of each ledger under one particular statement to test the accuracy of the ledger. That if the debit and the credit side are not the same, which means the left hand side and the credit side, if they are not the same, then it means that there was an error occur, and I believe my colleagues have taught you that, have taken you that, which means there was suspense account. We're talking about error. So we have trial balance errors, we have error that affect trial balance, we have error that does not affect trial balance. It can be reversal, complete reversal error, omission error, principal error. So it have commission error. So these are the errors that might probably maybe the reason why trial balance is not correct. So we have what extended trial balance. Extended trial balance is now the one that shows what the initial trial balance, adjustment, and the new trial balance. So on trial balance, normal trial balance, we just have what? We just have particular debts, debit side and credit side. But on extended, it means that this trial balance that you have, the initial trial balance, extended more than what you have at the moment. So when you talk about extended trial balance, you now say, okay, the initial trial balance, then you now have what? You now go for what we call you have the adjustment, then you now have your new trial balance. Now have your new trial balance. Your extended trial balance is actually what? It's like a working paper for auditors. Extended trial balance is like working paper for the auditor. It's used to make correction on the work or used to carry out financial final adjustments on what financial final adjustment on the financial statement. So look at the curriculum. That's for that 31st December 2018 is this. So they give us this particular information. So if you look at the trial balance, the figure here, the balances here, they are the same. Can you see? So we have the particulars. These are the particulars. We have the particulars here. We have the amount here. This the amount here is debit side. This is the credit side. It's not stated here, but that's what it means. The debit side and the credit side. So we have that, and they give us further information. The beauty of the classes that we've had over time, what will come into limelight right now, because we pick them one after the other to solve it. But this time around, additional information it will be given to you. So when they give it to you, you now say, what should how will I treat it to? But if you don't separate it, if you don't take it one after one before, it will not be easy for you to grab it. But because we have taken it one before, it will be very easy and straightforward to grab this solution now. So now let's look at the further information. They give us further information, which is what 400 naira is owned for eating and what and lightning expenses. So 400 is owned. We have consumed it, we have enjoyed, but we have not paid its own. But this figure, the trial balance given to us, it has not been affected. Please, additional information means that it has not been affected in what in your trial balance given to you. So how do you resolve that? So that's what we are talking. Please, excuse me, please. Okay. So now let's do so we have 400 for the 400 naira is being owned. So what when 400 naira is being owned, what do you do to it? It means that that amount that has been stated of is actually the amount that have been paid for, but yet they have enjoyed the capacity. Then what are you doing? That's what that's accrued. That's accrued. It means what you are owing that amount of what of 400. You need to add. You now trade. Where is your eating and lightning? You look at Italy and Lightning here. Italy and Lightning here is what? Is 5,000. This 5,000 is one that you have paid. It's not the total amount of what? It's not the total amount of what you have consumed. So you need to what? You need to now add the 400 to it. Now, when you add the 400 to it, the second leg will now go to where? You now go to your liability account. The second leg will go to your liability account. Please note that there are two ways for us to prepare financial statement. One of the way is firstly to solve the what? To solve the additional information, then start picking the additional information one after the other and start writing it on the what? On the question paper. Okay, this plus, this minus, this plus, this minus. But another way is what? Open everything. That's the second method. That was one of my colleagues might say, open everything, which means you are going to look at the items after you are done reading the question. They will now pick the items. You are going to highlight them out, state them one after the other. After you have stated them one after the other, you now start picking. You pick the one that does not have adjustment. You put them there. The one that have adjustment, you leave it. Once you have posted the one that does not have adjustment, you will now come back to the one that have adjustment and now started what? We will now start addressing it one after the other. That's for preparing your financial statement. So let's do extended trial balance question. So we have sales. So the first thing for us to do, let me show you the format for extended trial balance. Let me show you the format for extended trial balance. Yeah, because of I don't want to going up and down. I'm actually stay on this. So I'm actually stay on this. So we have what? We have that this extended trial balance. This is our extended trial balance. So now that we have this the format, the first thing for us to do is what? To copy the initial trial balance given to us. We copy it and put it there. So we call this one what? Initial trial balance. So we put it there. That's our what? That's the so if you look at the question up given to us, what we have just done is we have just copied down the trial balance. This trial balance here, we have just copied down all these figures, the name. Sorry. What we have done is just copied all this. We have just copied it all down here. And we have copied the figure. So that's what just we did, nothing else. Okay. Now that we are okay with that, the next thing is for us to now come up. I don't want to be scrolling up and down. Please, I believe you have your gadget now, so a laptop and a system, so that you can actually flow with it. Okay. But for the sake of this class, just for this one, I'm going to scroll up and I'm going to read all this. Is on for it we have 700 be paid for rent. So see, we have it is decided that a bad debt of 1,200 naira shall be written off, and that the allowance for doubtful debt should be increased to 4,500. Depreciation is to be provided for the year at what? 10% on cost. Inventory at 31st December 2015 was valued at what? At 16,000. So we will now pick the additional information one after the other. That's the adjustment. The further information is what? Is the adjustment that we want to do. Is further adjustment that we want to do. So let's start. First one says 400 naira and So credit for our accrual basis, which is the liability account. We're going to credit it. So how do we do that? We come back, you come to this place. I'm on this column now. Can you see it? So I'm working on this, is what we are talking about here. We are talking about this. Okay, so this is the line that we are talking about. So we have 5,000 there. Well, that 5,000 is the amount that we have paid, but we are what? We are owing 400 naira. So we come back on the debt side because we want to increase. If we want to increase it, they must be on the same side. Can you see on the debit? We have debit side. We have it on the debit side here. We have it on the debit side here. So it must be on debit. That's another logic that you can do if you are right or wrong. So we put 400 here. Then the second leg will be on the other side. But the account that's going to affect is what? Is the accrual. Or what is 400. That's the second leg. The accrual is going to our statement of financial performance as current liability. So now that we are done with that, we now look at the second information. It says that 700 has been prepaid for rent. 700 have been prepaid. It means we have paid advance. And when we talk about financial statement, anything you are fine, anything that is under your financial performance must be for the reporting period. It must be for the reporting period. If it's not for the reporting period, it is not expected to work to be found under your statement of financial performance. So that's why it's always in for the year ended. It means there's no continuation, it's just for the year. For the year ended. But whereas the statement of financial position is what? Is as at, which means next year it's going to change. As at is subject to change. As at. So let's look at this. So we have this 700 on rent. So we come to rent column upstairs. Now this 14,000 is the amount that we have paid, but 700 of it is prepaid, which means it's not enjoyed in year 2018. It will be enjoyed in year 2019. And this is a what we are preparing. We want to prepare for 2018, so we need to remove 700 from this 14,000. Then people put it under what? Under prepayment. Yeah. They now put 700 here under prepayment because what? Because we have not enjoyed it. So it'll be under the 700 here. Then the next one says that it is decided that a bad debt of what? 1,200 shall be written off, and that the allowance for that debt shall be increased to 4,500. So now the question is that it is decided that the bad debt of 1 written off. Now, what is the accounting entry for that 1-2? The accounting entry for the 1-2 is actually this: bad debt. We come to bad debt. Do we have bad debt here? So let's see the bad debt here. Let's see. Bad debt. There's no bad debt, right? Okay, yeah, but we have what we call trade receivables. We have the trade receivables. So we have trade receivables, okay? So because the two accounts that will be involved when it comes to bad debt is what? Is the bad debt and trade receivables. But what we have there initially is what? Let me come here. Let me do something here. Let me delete this for better understanding. So what we have there, if you look at this place, what I deleted right now, I have what we call what? I have new account opened. So it means that this is the initial transactions end here before this new account open. Then over time, additional information allows me to open new account. So I look for bad debts. I don't have bad debts here. I have trade receivables, and I know that any bad debt transaction is done on two accounts. It's done on what? The receivables account and bad debt account. So I'll come down here, receivables. What is the effect of bad debt on receivables? The effect of bad debt on receivables is that it reduces the receivables. So if it reduces the receivables, The receivables is on the debit side. So I need to put it on the what? On the credit side. I'll now come to what? I'll now say, okay, what about my bad debt? I don't have bad debt. So I'll create bad debt accounts. Bad debt account. I'll call it bad debt expenses. Then I'll now come here and put what? 1, 2, which is the second leg. Which is the second leg. Now, I'll now go further again. The additional information is 2. It said that what? And that the allowance for doubtful debt should be increased by what? 4, 5. So there's an increase in it. So once there's an increase, it means what? We need to, the initial one that have here is 4,000. We have 4,000 before. Can you see it there? We have 4,000 before. But now they have to increase what to 4,500. How do we increase it to 4,500? 2 things are also involved here. If you increase it, you come to allowance for bad debt, you put 5,400. The difference, increase it to 4,500, and we have 4,000. So 4,500 minus 4,000, we got 500, which means you just need to add 500 to it. Now that we have that, that's what will be the second leg. Anytime there is what we call increase or decrease, like I said, it affects 2 accounts. It affects the allowance for doubtful debt. It affects bad debt expenses. Bad debt expenses. But there are some people that normally create another account, expenses account for allowance for doubtful debt. But there's no need for that. You can actually post it under what? Under the bad debt expenses. So you come back here. So under bad debt expenses before, we have what? We have 1, 2. So we're adding that what to it? 500. So you do plus 500. Now the second leg. We have done the second leg. Then we move forward. What are the additional information? We have depreciation is to be provided for the year at 10% on cost. Depreciation is to be provided for the year at what? 10% on cost. So now, if depreciation is provided at 10% for cost, we now look at, okay, what is the cost of the asset that we are even talking about initially? Can you see it here? Depreciation is always on what? On the non-current asset. Depreciation is always on non-current asset. So we have it here. And we are expected to what? To calculate what? To calculate 4% of it. So depreciation is always on what? On non-current asset. So 10% of this figure, which is 146,000, will give us 14,600. And this 14,600, we have 2 legs as well. It have to what? It have to, number 1, it may increase our accumulated depreciation. We have 14,600. So we are put it on the credit side. Then it have to, this accumulated depreciation is now it's of and that's it. It still have to go to statement of profit or loss account, and in form of what? In the form of depreciation. In form of depreciation. Depreciation. And that will be what? 14 debit side. Expenses is like so we have now look at the that additional E. E has an inventory at 31st December 2018 valued at what? 16,500. And we said we value inventory at the end of the period. The accounting process affects 2 accounts. It affects the statement of profit or loss account, and also it affects the statement of financial position. The ledger that is in the position is there as well. The inventory is the inventory. Why the one that is it affected under statement of profit and loss is under cost of sales, under the cost of sales. So we come back here and put a closing inventory. Firstly, we're going to affect our assets, our current assets. Then the second one is what? Closing, because the accounts are not existing before. So we are creating new accounts. Create inventory. That's what P or L is what that will take that second leg. That's under cost of sales. Then come here. Okay, inventory, is it an asset? Yes. So it have what? Debit entry, that's 16,500. The second code is now good here, 16,500. So what have you done? You have done what? You have adjusted, you have done the accounting procedure for your adjustment. Next thing for you to now what? Generate your new trial balance. To generate your new, is this your new trial balance that will now be used to prepare your financial statement? So we have this to be 428,000. So purchases remain the same. Our purchase remain the same. We put it there. Now, the new trial balance, the result of the new trial is initial trial balance against the adjustment. So if the initial trial balance is on the debit side, there is means that what the figure on the debit side plus any figure on the debit side for adjustment, but the adjustment is on the credit side. There will be the debit side minus the credit side adjustment. So our wages and salary is the same. So we put 4,000. Wages and salary is the same. We put 64,000. So our rent, there's an adjustment on our rent. On our rent, we have 14,000, which is on the debit side. But our adjustment of 700 is what is on the credit side. So it means that it's negative because they're not standing on the same side. One is on debit, one is on credit. So it means that what there's a difference there. So it will now give us 14,000 minus what? Minus 700,000. That will give us what? 13,300. We will move down. 8 and what? And likely. That's 5,000. 5,000 is on debit side. 400, the adjustment is on debit side. That gives us 5,400. Another one is what? Inventory as at 1st January 2018. So now, inventory as at 1st January 2018 is 15,000. No adjustment. So we have to see about what? Our 15,000. Another one we have is what? Drawings. No adjustment. We have our drawings. We have put there. Another one we have allowance for that there's an adjustment there. So, and there's an increase, which means they are both on the what? On the same side. So 4,000 plus 500, they give us 4,500. So this is what I'm doing, 4,000 here. The 4,000 here plus 100 here. We give us what? 4,500. Then we move on to what? Our non-current asset, there's no adjustment on that. So we have that to be what? The same. After that, we move to our what? Our accumulated depreciation. Now, if you look at our accumulated depreciation, there's an adjustment there. We have that to be 32,000 and 14,000. It has increased. So 32,000 plus 14,600 will give us, that will be 46,600. 46,600. So we move to the next one. Trade receivables, 51,000. But our adjustment now is on the what? Trade receivables on the debit side, under the initial trial balance is on the debit side. But the adjustment is on the what? On the credit side. So that's why it's negative. So 51,000 minus 12 will give us what? We press the calculator, it should give you 49,800. We now have trade payable remain the same, so we have 42,000. Another one is what? Cash. Cash remain the same, 6,200. Another one we have capital as at remain the same, 121, 600. Now we are now our new account now. We need to bring our new accounts down to our trial balance. There are new accounts now that we have what due to the additional information we have created them to now form our part of our balances for new trial balance column. So we have this to be what 400. We have this to be 700. That's our prepayment. What we have paid about our current assets, prepayment, current assets, 700. Then we have our expenses, bad debt. So we 1, 2, and 500. 1, 2 plus 500 will give us 17. That will give us 17. Then after that, we have depreciation to be what 14,600. And then after that, we have what 16,500. Then you go up 60,500. So now that we have that, Then the next thing for us to now do to now press to add. So press calculator. If you press the calculator, what will they give you? So let's press calculator. So 30 something thousand 304 plus 400 plus 64 plus 13,300 plus okay plus yeah. Okay, if you press the calculator, that should give you 659 600. So it should give you the same thing. If it does not give you the same thing, then it means that what we have done wrong thing. But I believe we are right. So it should give you the what? The same thing. It should give you the same thing. Okay. Now that we have given us the same thing, we now what? We now press forward. We press forward. Okay, now let's go. Let's continue. Okay. So now let's move on and let's look at taxation on profit. So taxation on profit is that organization, they expect to work companies, they are legal persons and they are liable for tax. Just like the way we pay our pay as we earn, company also pays company income tax. It's actually very important for them to pay tax. But in the beginning of the class, for the first class that we had together, I explained that we have what we call number one, we have the proprietorship. Number two, we have the partnership. Number three, we have company. And I said that the proprietorship is actually the one that was one-man business, and partnership is what? The combination of what? 2 to 20 people coming together to form a company with the same interest to actually make profit. These two people don't pay company income tax because their own tax is based on the total money that has been paid to them. So, as like for example, sole trader is the owner of the business, so the tax in based on the that reward that you have earned, not on the business. So because it's also the business, so the tax in based on what's that earned. Partnership as well, the tax what they pay to the partners. So the companies the partnership don't pay, but they pay what they don't pay company partners, but they are what they pay the amount that has been paid to the partners. They paid in taxes on the amount paid to the partners. But for companies are what are liable for tax. They're expected to pay tax. It's expected of them to pay tax because company is that the ownership is measured in shares. Company ownership are measured in shares. So if you have shares in a company, then you are part of the owners of the company. Companies are different because the company has the liability for tax taxation that is reported in a statement of profit or loss and statement of financial position. So under the statement of profit or loss account, you'll find you find tax decision there. When you get to your profits, you now say there's something we call net profit before taxation. It means that you have not deducted your tax from it. Then you now deduct your tax from it. Is that figure will now give us what? Net profit after tax. Is that figure that you're going to take to your financial position? I'm going to take your financial position. So the statement of financial position actually what? Is the core tax. But let me say this. The amount that you estimate or that you state on the financial statement of financial is actually different from the actual tax paid, which estimated figures on the statement of financial performance is different from the actual liability or actual tax liability paid. So whenever that occurs, it means that what there's a possibility of what we call overestimation or underestimation. You can either overestimate or underestimate. Now, if you overestimate, because there are some expenses that are not allowable, but you are under your financial performance, you have used it to reduce your profits. But under tax, they will add it back. And that also depreciation is not allowed in tax. but they give another name what we call allowance, capital allowance, which they have their own percentage to calculate it. So these are the reasons why we have the differences between the figure of the tax that we normally file against the actual tax liability when they come for tax clearance or tax audit that we actually paid for. So whenever there's a difference like that, there's an accounting entry that we need to do. So now if in year 2018 on my financial performance, I stated that I'll be paying tax of 20,000 in 2018. But in 2019, and I noticed that I'm not going to pay that 20,000 again. I'm only be paying 150,000. There's a reduction of 50,000. The process is that I will need to reduce my current year, which is 2019 on tax, with that amount, which is 50,000 naira. I will explain again. Under the overestimate or underestimate of tax for previous year. My 2018, my tax, I was estimated that I was going to pay a tax of 200,000. That was my estimation. Okay. Then I looked to it like, okay, in year 2019, and I noticed that I've overestimated that my actual tax is 150. In year 2019, my tax I'm going to pay that I'm estimate for 2019 is, let's say, is 300. But because I have overestimated the 2019 figure, I will now use that 50,000 difference to reduce my tax that I'm going to estimate in 2019 by what? By 50,000. That'll be 300,000 minus what? Minus 50,000. And that will give us what? 250,000, which means my tax that I'm going to record in year 2019 will now be 250,000. The opposite is what? Is the other way around. Which means that if I underestimate, I'm expected to estimate 250, I estimated 200,000. Okay, fine. Following year, you now find out that it's 250. The following year, any addition that I have, any current tax for that year will be what? Increased by the difference of under estimated figure of 2018 of previous year. That's for under the what? Under the financial performance. Now, under the financial position, we have what we call the what? The opening figure. We have tax liability. We have the opening balance. After we have the opening balance, we add the one for the year to it. They deduct the actual amount paid to give us the balance that we are here to pay for. That's what we have here. So for taxation, this is what we have here. So we have tax payable at the beginning of the year. We have it there. So we pick that. That will be closing tax payable at the end of the previous year. So it will be your opening balance at the beginning of the year. Another one that we have is what? Is tax charge for the year. Tax charge of the year is what? The one that is coming from the estimated figure that is coming from the statement of performance. Now, any adjustment that we have made, maybe it's over or under, that figure is the adjusted figure is what we are going to put under the tax charge for the year. Then after you add the two together, you now less the actual amount of money. You now less actual amount of money paid. So let's say, for example, my payable is 20,000 naira, and for the year is 5,000 naira, which means the total amount of money that is payable for that current year or at the moment that the reporting period is 25,000 naira. And I find out that I pay 10,000 naira during the year. So that 25,000 naira minus 10,000 naira will now give me 50,000 naira. That 10,000 naira is what will now serve as payable in my financial position under my current liability. But if it's the one tax that I will not pay following year, I'm going to pay in the next 2 years, it will now be found under my what? My non-current liability. Now let's take an example for that and what to do. Farfetch company has a financial year ending on 31st December. At 31st December year 4, it has a liability for income tax of 77,000. The tax Okay, sorry about that. So the tax on profit for the year to 31st December year 5 was 201,000. Okay, 201,000. Okay, the tax charge for the year to 31st December year 4 was overestimated by 6,000, which means the previous year, year 4, the previous year was overestimated by 6,000, which means the effect will be on the current year tax. During the year to 31st December year 5, the company made payment of 150,000 in income tax. So they made payment of 150. Calculate the tax charge for the year to 31st December year 5 to include in the statement of profit or loss. I'm coming again on that. The tax charge for the year to 31st December year 5 to include in the what, statement of profit or loss. Also, the second one also is saying that what the figure to be included in what in statement of financial position. So in order to do that, so let's come down here for because of our so the A part, the amount to do what to be included in statement of profit or loss account. So we have we're going to start with the adjustments, with the adjustment. So we have 6,000, the overestimate, we overestimated last year, which is year 4 of 6,000 naira. So what is our current year? We go up here. What is the tax rate? The tax for the current year is what? 201. Okay. So if the tax on profit for the year, I'm reading this place, the tax for the profit, the tax on profit for the year to 34 December year 5 was 201. So we have 201 here. So we have this to be what? To be 6,000. So you come here and put, okay. So we put, it should be 201. Sorry, for clarity purpose, let me do something. Okay, now we have a clean sheet now. Okay, so we have the first one is adjustments for what overestimated. We overestimated it, so we need to. Last year we said that it was 6,000, whereas it was 160,000 naira. It was 54,000 naira. So it means that we have overestimated last year. So we need to add it, remove it. We now do bracket, remove it. 6,000 naira from the question. Okay, what is the tax for the year? These we are removing from where? From the tax for the current year, which is year 5, and it's 201. That's the current year, year 5. Now, if we remove this together, if we now say, okay, 205. So let's pick calculator. Let's pick calculator. So we have that to be 201 minus 6. We give us what? 9195. It means that the amount of current year charge that we're going to find under our statement of profit or loss account will be what? 195,000. It will be 195,000. 195,000. Now, after we have gotten that, the next thing for us to now do what? To now come down here. So to now decide the figure that we are going to display under our statement of financial position. So the figure I'm going to display under our financial position will now be what? We start with tax payable at the what? At the beginning of the year, which means the closure of 4. Now, if you look at the upstairs here, it's stated here that says that the let me see, yeah. Okay, can you see it here? That at 31st December year 4, it had a liability for income tax of what? 77,000. Income tax. There are different type of tax, so you have to be careful. The tax, so you don't pick VAT tax and use to work on withholding tax. No, you have to pick what tax. So this one is talking about income tax. So we have that to be 77,000. Then tax charge for the year. This tax charge for the year is this calculation that we have done here that we are going to bring down to this tax charge for the year. It means that if you miscalculate this figure, then the figure that will be represented on our statement of financial position also will be what? Will be wrongly represented. So we have this to be 5,000, 195,000. Now, addition of these two will give us the total liability that we what? That is expected of us to clear for the year. So 77,000 plus 195. That will give us what? 272,000. So this is the total cost that is payable for the farm. So, but they now told us that he make a payment of 150,000. Make a payment of what? Of 150,000. So if you make a payment of 150,000, it means that our total liability for the year have reduced by 150. So it will now be 272 minus 150,000. That will give us 122,000. 122,000. If you give us 122,000, this 122,000 a figure that will be what? That will be represented or that will be displayed and shown in our statement of financial position as current liability. As current liability. Okay. Okay. Because of our time I've spent, apology for starting behind schedule today. So because I don't want to take too much of your time at the same time. So I would like us to also I want to know if you have any question. From next class, we are going to start from there. We're going to start from We're going to start from issuing of equity. So we are not going to rush this. At least for 3 or 4 classes, we are going to be using this material for us to understand it because it's key. Once you understand this, is actually what it will move. It will help us a lot. So let me see. So Mr. Kennedy, do you have any question for us? Mr. Kenny, do you have any question for us? I'm trying to, I don't know why it's not unmuting. I'm trying to unmute. Okay. Okay, please, if you have any question, kindly send to me so that I can actually what? I can attend to you because you understand is actually very, very important. So please chat me up from the chat here. There's no question here. I don't know why it's not unmuting. So please kindly chat me up if you have any question for that question or more. If you need more explanation on what we have done so far. This is what we have done IS1, and we are trying to calculate, try to prepare a financial statement in line with that. So in absence of any question, as comes no chat, I want to wish you happy night rest and see you next class. Thank you.